Thank you and good morning to everyone. Again, my name is Joshua Franklin, and I'm happy to be here presenting with ILT Academy this morning. We will be speaking, or I will be speaking directly on business formation for entrepreneurs, and also walking through some considerations on, what kind of entity you may be able to form, what are the different kinds of entities, and also talking about when to incorporate as well. So if you have any questions throughout this presentation, please drop them in the chat and we will keep an eye on those and be sure to continue throughout the presentation. So with that, I will officially get started today. And so, some things to consider for your initial questions as we go through this is why should you create an entity? When should you incorporate? What are the different types of entities? And then some considerations to be made prior to incorporation. And so, briefly, I want to walk through a basic overview of how to form an entity here in Minnesota, and then we can go through the specifics of when, how, and why to incorporate as well. But the basic steps to incorporation in Minnesota is to first select your entity type, and this will be done directly on the Secretary of State's website, and you'll be able to file your paperwork here, and then you'll choose where to incorporate. For the purposes of this presentation, I will assume that everyone is incorporating in the state of Minnesota. And I bring that up particularly because there are some interesting state laws and opportunities that Minnesota provides to their entrepreneurs that are sometimes not offered in other states as well. And so after you choose the type of entity you will be incorporating, you'll then choose a name for that entity. Of course, as you may know, all names of your entity in the state of Minnesota must be unique. So there will be no other ILT academy listed in the state of Minnesota. And we can also talk through some of the considerations on a national level as well. And after you complete that, you will then register with the Secretary of State. You may receive some corporate documents, which will be the articles of organization or your articles of incorporation. And I'll talk through a little bit more about what those are particularly. And then we'll take care of some additional corporate formalities. As you may recognize, some of the corporate formalities are different for the type of entity you choose. And so as I go through this presentation, think about maybe your own entity or a friend's entity, and feel free to drop any questions that you may have. And so to jump right into it, there are four different types of entities, and I'll go through them in what I think is the most the most simple to the most complex tense. And so in the state of Minnesota, you have the sole proprietorship, which is often known as the single owner. Then you have for profit companies, which may be C Corps, S Corps, LLCs, etc. Then you also have nonprofit companies, which may also be some type of quasi or hybrid company, which in the state of Minnesota is called a public benefit corporation. In other instances, you may also hear of a public benefit corporation being known as a B Corp. And lastly, I note sometimes for individuals the professional company liability. This covers your trades of profession such as lawyers, doctors, accountants, and etc. And so, similar to the considerations to be made at the beginning of the presentation, these are the types of entities, and the documentation for each one of these entities is different. The purpose for choosing an entity may be different based on where you are in your business, the type of funding that you are bringing to your business, and maybe also potentially the longevity or the long-term plan for your business. And so we'll talk through some of that as well. And so jumping right into it, and sometimes why I consider the sole proprietorship to be the most or excuse me, the least complex, and the corporation to be a little bit more complex, is based entirely on paperwork. And so in this scenario, for a sole proprietorship, no paperwork is required to operate your business. So if any one of you all here in this presentation today do not yet have your entity incorporated with the state, whether it be an LLC, an S corp, a C corp, etc., you are still a business owner, and you are a business owner in the form of a sole proprietor. And so, what this means, and we'll go through this a little bit more, is that you operate your business under your own personal name, and you operate that business as kind of an extra arm to yourself. Now, an LLC or a corporation is not considered a separate arm, but is actually considered an entirely separate entity. It's something like having a child or having a sibling or having a twin, depending on, how you think about your business. But in any regard, talking about the differences between an LLC or a corporation, which I will also get into in a little bit greater detail. One of the main differences are the type of documentation corporate documentation that you receive. So, for example, if you file for your LLC, you will receive what's called your articles of organization. Whereas if you file for a corporation, you will have articles of incorporation. And so there's no difference per se in terms of what that means, etc. But as we get into some of the additional considerations as to why you may choose to have an LLC or why you may choose to have a corporation, these may be some interesting considerations for you to consider. Now, for both an LLC and a corporation, which is different from a sole proprietorship, you will have what's called an EIN. And an EIN stands for an employer identification number. Now, because your entity as incorporated would be considered a separate person from you rather than a separate arm like the sole proprietorship, you will have a separate, what I would call a social security number. So, in the context of a sole proprietorship, you recognize your business with your social security number. Whereas after you have incorporated your entity, you recognize your entity through the employer identification number. And lastly, the last primary difference between a sole proprietorship and an incorporated entity, such as an LLC or a corporation, is the annual renewal and other reporting requirements directly to the Secretary of State. So, in a sole proprietorship, your only requirement for paperwork would be necessarily to file your taxes every year. And this is no different whether or not you're an individual or you're a business. Taxes are required for all persons in the United States. Whereas for your LLC or your corporation, in addition to a tax filing, you will also have a state filing with the Secretary of State. This is called the annual renewal, and this asks some basic questions about your business in terms of employees, in terms of the type of business that you're doing, as well as the amount of revenue that you have. Much of these are for reporting requirements for the state, and also is a corporate formality that some business owners choose to get ahead in their business or to make themselves available for different grant funding or other funding opportunities. So, to speak a little bit more in detail about the sole proprietorship is the basic framework for all business owners. So, anybody who has put an idea into practice is a sole proprietorship. And essentially what that means is you are a business owner and you own your business solely, and there is no registration paperwork required in order for you to identify that you are a business. You can have a name for that business, you can operate that business, pay other people, etc., but there are some limitations. And the primary limitation to a sole proprietorship, as given through the word, is simply that a sole proprietorship is limited to one individual owner. And separately, which I will get into in some of our later slides as well, is you have a greater potential for liability as a sole proprietorship. And this is because all of your income, as well as all of your business assets, are linked directly to your individual status. rather than having a separate, what I like to call an umbrella, or a separate person that will limit some of that liability. And so that's kind of where the term limited liability comes from with respect to LLCs. Um, but in any regard, I do often talk to many business owners who often think, they have to be incorporated to be recognized as a business. That's not actually always entirely true. Simply by having a, a business idea and putting it into practice and either spending money on that entity or making money on that entity qualifies you as a business owner. Now, you are not a LLC owner and you are not the member and you are not the owner of a company, but you are the owner of a business. And you have the opportunity to have tax deductions from your business for all of the necessary and ordinary expenses from your business, as well as do business with other entities. However, many business owners or other businesses that are engaging with other businesses often require you to incorporate your entity, sometimes because there are a bit more benefits to having an incorporated entity, in addition to limited liability, which is very beneficial in the event that your business grows and people start to recognize that you have some funds, or as your business grows, you hit a stump block and you need to either slow down, restructure, or otherwise. And thank you for the questions so far. I'm reading them as they come in. And so, another form of entity or another form of a type of an entity is also a partnership. And I talk about this a little bit in tandem with the sole proprietorship, but a little bit differently from the LLC and the C corporation conversation, because this is considered a quasi type of entity. And so here, this is similar to multiple sole proprietors working together. This would have the effect of allowing two individual business owners to work together on one individual venture. Think of this something like a joint venture where two people come together and decide to partake in a business together as owners rather than as maybe a service contractor or otherwise. Now, in these contexts, these partnerships usually are general or they are limited. And in a limited partnership, one person may contribute capital to a partnership and they would be held liable to the company for any capital placed into the company. Similarly, you can have a general partnership where all of the business owners are jointly and individually liable for all of the obligations of the partnership. This is similar to the LLC, excuse me, this is similar to the sole proprietorship in that one individual owner is entirely liable for all of the obligations of that entity. Now, for a partnership, all of the partners are jointly and separately liable for all of the obligations of that partnership. The step beyond that then becomes the limited liability company. And so the limited liability company allows you as a business owner with a fair amount of flexibility from your sole proprietorship and your general partnership to have an opportunity to incorporate your entity. Now, in the state of Minnesota, excuse me, limited partnerships are uh, restricted entirely to professionals such as business owners in practicing law, lawyers, accountants, where we, in addition to our limited liability status as the company, do undertake some additional liability individual as an owner. But generally, for service based businesses and product based businesses rather than professional companies, the limited liability company really provides a fair amount of flexibility to business owners who are not only seeking to build a business, seeking to bring a product to market, or seeking to provide a service, but also in terms of privately funding this business in any way that you may see fit. And so, in a limited liability company, that is a full blown entity that provides you with separate liability from yourself. And so what that actually means in practice is if your business is sued, you individually as the owner will not have any general liability to that um, judgment should one be found. So, in the event that your business is sued and you are held liable for non payment or violation of law or otherwise, and you're fined, let's say, as small as $1,000, rather than you individually being on the hook for that $1,000, the only person that would be required to pay that $1,000 is your business, which is why it's a lot different than having a sole proprietorship where you are just having a third arm that has to pay that judgment. Instead, you have an entirely new person that needs to pay that judgment. So now, if you have, for instance, a $200,000 home, you don't say, I have a $200,000 home and certain people will be able to lien my home in order to pay the judgment. Instead, you, the individual owner, owns the home, and the individual business owns whatever assets they own outright, in addition to all of the money in their bank account. And so that creates a protection and umbrella for the individual owners from being on the hook in as you would be in that sole proprietorship or general partnership or limited partnership context. And so here, the liability of the owners is only limited to the amount of capital they've contributed to the business themselves. And so if the business was fined $1,000, but I haven't put $1,000 into the business, then that additional liability does not fall on myself, nor does it fall on the business. Now, additionally, LLCs similar from or dissimilar from the sole proprietorships, there's no minimum or maximum amount of owners. You can have one owner of a LLC that's called a single member LLC, or you can have 200 owners of an LLC with every owner receiving 0.5%, or you can have 200 owners with one person receiving 99% and the additional 199 people apportioned appropriately. And so there's a really wide range of flexibility in the ownership structure of an LLC, which provides a lot of entrepreneurs a lot of calamity and opportunity to grow their business in the way that they see fit. In addition, you can also have multiple members of ownership classes. So, for example, similar to publicly traded companies that often hold their high executives owning one amount of shares of the company and the investors holding another amount of or another type of share of the company, usually related to voting rights of that company. An LLC can also create multiple membership classes. So what that means is you, as the individual owner of the business, may choose that you and a small group of people will have this class of ownership, which comes with the ability to sign contracts, make payments, vote on important decisions, etc. And then you can have another set of owners that don't have the ability to make decisions on the corporation, but may have a fair amount of input on that. Or you can apportion their responsibilities entirely in the way that best fits your business and allows it to grow. In addition to the administrative side of your business, which will allow it to grow in the way that you see fit, having a entity that is formed with the Secretary of State also allows you a fair amount of flexibility with your taxation for that business. Now, what that means is you as an individual may choose how you are taxed once you have a business, dissimilar to how you may not be able to choose how you're taxed if you are an individual. And so, what this means, for example, is when you are an LLC, at the end of your taxable year, you can claim that your business has a loss. And so, what that means would be your business spent more money than it made. And now your business looks like it's in the red. for business purposes. And because you have an incorporated entity, what both the tax code and state law allows you is to carry over your losses. And so carryover losses essentially allows you to take, let's say, that $1,000 judgment that you received that wiped your business accounts clean and now you're in the red $1,000. You'll be able to apportion that loss over years. And so you can say in year one that your business uh, only had a $200 loss. And then the next year, your business only had a $200 loss. And so potentially by year five, when you've made $20,000 because you've been in business for so long, you now don't have the entire $1,000 liability that you've had in year one because it's been apportioned out over the years. Unfortunately, when you have a sole proprietorship, you're not allowed to claim a loss on your business. Instead, you're only allowed to get up to zero. And so the LLC provides you an additional flexibility to maneuver with your taxes in a way that's beneficial for you and the rest of your family, whether you are filing single, whether you have dependents, or whether you're filing jointly as well. Additionally, you can choose how that company is managed. And so there's a lot of flexibility with respect to LLCs. And this is why many business owners look at LLCs as being some of the most viable structures for them. I'll talk a little bit through the S Corp and the C Corp, which will kind of touch on a little bit of the considerations as to why certain people don't choose LLC. But nonetheless, I will share a little bit more flexibilities and then talk about some of the restrictions as well. And so for an LLC, they can both be managed by the members, which are the owners of that LLC. The owners of the LLC can choose to create a new class of members that don't necessarily have ownership rights, but have management rights to that entity. That would be considered a manager managed entity. Or you can also choose to elect a group of people who make decisions for that entity, and that can be board managed as well. Now, for all LLCs, similar to the sole proprietorship, any profit or loss from your business will pass through to your individual tax return. Now, what that means is if you make $1,000 and you have a profit of $1,000 in your business as a single owner, you now have an additional $1,000 of reported income on your taxes. Similarly, if you have a business loss, you have $1,000 less of taxable income on your business. And so you can kind of see and understand where that difference from your business income may change a tax bracket for the better or change a tax bracket for the worse, or may cause you to take a little bit of a closer look at many of the deductions or many of the tax credits that you may also be receiving. And so limited liability companies really do offer business owners a wide range of flexibility to operating their business taxes, which may affect their personal taxes through this pass-through taxation. And this last point here just talks about the developed case law on the status of an LLC. As you all may have heard, it's the best to incorporate your entity in the state of Delaware. And so this is actually what is true for a corporation. And this is because throughout the United States, Delaware, one, has no corporate tax, two, has the lowest income tax for corporations. And there's been a myriad of state and federal case law on corporations and how they are taxed when they are in Delaware. Now, for LLCs, because this is more of a state law issue rather than a federal taxation issue, there's less developed case law. The case law differs through different states. And one, although this creates more flexibility for the individual owner, there is less certainty as to whether or not your LLC I won't necessarily say is compliant, because you all as the business owner are able to make the rules, but whether or not the rules of your business may match up with the rules of another business in a way that would be beneficial for you. And on the flip side, the opposite of an LLC, in my opinion, I would say is a corporation. And a corporation is your traditional entity. This is usually known as your publicly traded companies or companies that are issuing shares, because LLCs do not issue shares. They have membership percentages, whereas corporations, they issue shares of the company. And at the time that you file your documentation, you as the individual owner are able to choose how many shares of a company that you are able to have. And so you as the individual business owner can choose to have 10 shares, 100 shares, a million shares, 10 million shares, as well as set the price for those individual shares as well. Now, unlike the LLC, which has passed through taxation, at a corporation level, your income is subject to corporate tax. Now, what this means is if you have $1,000 at the end of your business bank, at the end of your business taxable year, that $1,000 does not pass through to your individual tax return. Instead, you have a new tax return with a new tax bill that says, okay, you made $1,000 this year. We're taxing 33% of that. And I believe in Minnesota, it's at 21%. And then the federal is at 33 at this point. And so you will pay 33% of that $1,000 as a federal corporate tax. And then you will pay 21% of that $1,000 as state corporation tax. And so, as I indicated earlier, in the state of Delaware, there is no state incorporation, or excuse me, state corporate tax. And so, instead of in Minnesota, where you would be charged an additional 21%, in the state of Delaware, you would not be charged an additional 21%. You would only be subject to federal corporate tax. And so that is often one of the main reasons why it's widely known that business owners should incorporate in the state of Delaware. However, if you are not a corporation and you've chosen to incorporate as an LLC or as an S Corp or as a nonprofit, that's not necessarily your determination. And so, in addition to corporate tax, you have income tax, you have capital gains tax, you have sales and use tax. All of these other taxes are also to be considered. And so, having a C corporation allows you to maneuver through the different taxes a little differently. You can carry over certain taxes. Corporations are only required to pay half of payroll taxes, and they are allowed to forego the other half of the payroll tax to the employee. And that's where your Social Security, your Medicare, and other taxes directly come from when you are a W-2 employee. Is the corporation that you work for is sharing their taxable liability directly with you. And so what that looks like in the state of Minnesota is rather than the corporation paying the entire 33%, they pay half of that 33%, and the other half comes directly out of the employee's paychecks. An additional for C corporations are owned entirely by the shareholders, similar to the LLC, which is owned entirely by the members. All C corporations are governed by a board of directors, whereas in the LLC, you can choose whether or not it's going to be governed by the members, the shareholders, the board of directors, the officers, etc. And so here are some of the formation documents as we talked about, the articles of incorporation. You may also have some additional documents like some bylaws or some individual shareholder agreements. This is kind of where your different class of shares may come in. You may have class A of shareholders who have all of these additional rights, and you may have class B of shareholders that don't have the same voting rights that the owners or the board of directors may have, but they still have a level of input. And this is oftentimes used as a funding tactic to individuals or to third parties during your capital formation. And so what that looks like is if I'm growing my C corporation and I'm looking for outside investors, I may choose to sell stock in my company. This is different from having an LLC because we don't sell stock in the company. You would buy a membership interest. And so, whereas in the LLC, I would be saying, hey, give me $10,000 in exchange for 10% of my company just to keep the numbers rolling on the 1,000. In a C corporation, you can say, I'm going to issue you X amount of shares subject to this shareholder agreement, which comes with these certain rights in exchange for your $10,000. And so this provides business owners a wide range of flexibility in choosing what type of considerations they will make in exchange for the funding that they're receiving. Whereas in the LLC context, you kind of take it as a catch-all. And in the C corporation, you're able to apportion that liability as well as their individual ownership rights as well. And so similar to the LLC, of course, as a registered entity, you do have limited liability. And just like the LLC, you're allowed to have multiple classes with different rights and preferences for each class. The only difference between the C Corp and the LLC, again, is that the LLC does not issue stock. And I did see something in the comments about double taxation. And so one of the disadvantages of a C corporation is that double taxation. It essentially is that you will be taxed at both the federal and the state level for corporations tax. Now, you won't be taxed at the federal and state level for income tax. However, you will be taxed for corporation tax and then the other taxes such as capital gains tax, dividend tax, gift and estate tax, sales and use tax. All of those other taxes do still apply, but it's the corporation tax that corporations can't get away from, but that LLCs are not required to pay. Instead of paying corporation tax, LLCs actually pay self-employment tax. And so this actually brings me to another little bit of a hybrid, similar to like that partnership, and that's the S corp. And the S actually stands for self-employment. And so this is a using the right words, but not trying to confuse my audience here. The S corp is a hybrid LLC. And the reason why I talk about the S Corp after I talk about the C Corp is because the C Corp and the S Corp are very similar. However, they are different in that S Corps are just LLCs that are choosing to be taxed as an S Corp. And so what that means is you are an LLC that has chosen to be taxed like a self-employed corporation. And so here, the S Corp is not required to pay corporate tax. However, there is no pass-through taxation. So there will be a separate tax bill similar to the C Corp for your S Corp. And so if you have that $1,000 of business income at the end of the year, you will be charged self-employment tax on your business income as opposed to be charged self-employment tax on all of your income that would come through if you were an LLC. And so self-employment tax in the United States right now is held solid at 15.3%. So, lawyers are all bad at math, but keep the numbers simple here. I think 15.3% of 1,000 would be $153, I think. Yeah, something like that. But in any regard, that would work differently than having an LLC where you would pass through that $1,000 into your additional income. So if you have a spouse that makes additional income and you all are filing jointly, that additional $1,000 is added there. Or if you have no additional income, that $1,000 becomes your income. The something to consider there is if you do have additional income, you are being charged self-employment tax on all of your income, not just your business income. So dissimilar from the S Corp, which would allow you to only pay that $153, you will essentially be paying 15.3% on self-employment tax on all of the income that you have. which may be a good thing for you depending on where you are, and what type of other tax deductions, tax credits, and other tax liabilities you may have on your individual forms. Or you may choose that it is better and more advantageous to keep it separate, and then you may choose to elect as an S corporation. And so an S corporation, as I stated, is a form of an LLC. And so here you will receive uh, your limited liability. You'll have that pass through taxation. However, some restrictions on S corporations that are set directly by the the IRS. And so the IRS limits S corporations to only U.S. individuals as owners. There are some limited exceptions where individuals who are U.S. expats or still file a U.S. tax return may be eligible to own an S corporation, but generally they must always be U.S. citizens. And essentially, as you can imagine, this is to ensure that they're paying their fair share of taxes. And so they don't want to allow outside agencies that don't have the same reporting requirements to also benefit from not having all of their income lumped together. And also to ensure that there is not a disproportionate amount of taxation. The S Corp is only limited to 100 members. And so essentially what this means here is that, dissimilar from the LLC, which you could have 200 members, you for a or a million members. In an S corporation, you can only have a maximum of 100. And so obviously it's not as flexible as in the structure as the LLC. It requires you to do more tax filings. It requires you to follow specific IRS rules. And so being very strategic with your business and kind of jumping into, when do I incorporate? What kind of entity do I incorporate? And why should I incorporate? These are some of the things that oftentimes people think about when choosing what type of entity. What kind of business are they doing? What kind of profit are they expected to make? What are the potential overhead costs of that? Who are the other business owners and what are their individual tax filing statuses, such that it may be beneficial to incorporate as an S corp and then move to a C corp at a later time, or start as an LLC and then move to a C corp at a later time, or start as an LLC and then choose to make an S corp election, and then maybe later on down the line, at the time that you're seeking outside funding, to then transition to a C corp as well. Or is it better to have one LLC, and then as your company grows, when it's time for investors, to start a brand new entity, and then have a brand new entity be a C corporation? And then how do those two entities work together? These are oftentimes real considerations for business owners that they go through, not only after they've got into business, but prior to incorporation as well, just to create a very clear plan that they can either add to their business model, share with the bank, share with other partners, or just have a very clear idea of how their business operation should run. Now, I'm going to pivot entirely from the idea of the for-profit companies, and I'm going to get into the non-profit companies. Now, we have, as you may know, your traditional nonprofit corporation, which requires it to have a charitable purpose. And if it has a charitable purpose and you receive a determination letter from the IRS that you are tax exempt, you become exempt from income tax. You are still required to pay a level of corporate tax or a level of sales and use tax. The sales and use tax is refundable in the same way that a business expense is deductible. And there are also a fair amount of reporting requirements to nonprofit companies, such as your tax forms. They're all public. And your bylaws are also directly public with the IRS as well, and may also be public with the Department of Revenue in the state. And they require you to have at least 3 members on your board. And dissimilar from an LLC, which generally states the LLC has owners, there are no owners of a nonprofit because there is no profit to tax. So there is nothing that nonprofit owners own. Instead, they are members of the nonprofit. And essentially, what that means is they are members governed by the bylaws and the corporate entity structure. And lastly, another hybrid of the nonprofit structure is called a public benefit company. And you all may have heard of this in terms of the B corporation, which stands for a benefit corporation. And in that regard, a B corporation, for the purpose of this conversation, is an entity that provides a public or a general specific benefit to society, or it's an environmental well-being that's going to benefit past and future generations. And this language is taken directly from Minnesota statutes, and many different states choose to recognize B corporations. However, B corporations are for-profit entities still. The IRS nor the federal government have allowed public benefit companies to have any tax exempt status. And you may have heard of, how a nonprofit is working together with the for-profit entity. And so because of the LLC Act, which passed in 2010, and a lot of different mergers that happened between your nonprofit and your for-profit company, Minnesota and about 33 other states have drafted laws that also acknowledge public benefit companies for the purpose of state law, but not yet for the purpose of federal law. So at this time, they're still subject to federal and state income tax. So that concludes the different types of entities. Now, as I spoke of in the very beginning, those are all different from a sole proprietorship. In that a sole proprietorship, you don't have any liability shield. There are no shared ownership because you are the only right. You cannot have essentially employees because you don't have a registered business to have a business bank account to have payroll. And lastly, your business is not its own entity. It's just a separate arm of you individually. So in tandem, some of the benefits of that entity formation provide that umbrella liability shield that I've been talking about. It allows you to have shared ownership as well as shared governance rights between you and all of the business owners, whether those be equal rights or unequal rights that work better for the business. You may choose to have your individual owners become employees for different incentives such as options, restricted stock, IRA benefits, and every other business benefit that you all may have in your individual employer that your employers may offer to you all. And separately, the business is its own entity, and I can't talk about that enough. Similarly, because once you have a business that has its own entity, you can open a separate bank account from yourself that is not connected to yourself. You can operate separate business contracts that are entirely separate from your obligations to yourself. And those business contracts can also be delegated in a different way that you would not be able to delegate things that are in your own name, etc. So these are some of the benefits of business incorporation, such that they provide you a wide range of opportunity and also provide you with a wide range of flexibility to own your future, as I like to call it. Now, in talking about owning your future and getting to that stage where it is time to potentially incorporate, I often tell business owners to think about some of these considerations prior to your incorporation or your formation. And the first is the length of time operating your business. Now, everybody often thinks, once you have a business idea, immediately go to the Secretary of State. and incorporate your entity. That's not always the best because it can be extremely overwhelming to have a lot of these new reporting requirements. Now we're talking about taxes. Now we're talking about bylaws. Now we're talking about also operating the business. Now we're talking about setting up a new bank account. Now we're talking about should I move my C corp from Minnesota to Delaware? And it's oftentimes unduly burdensome to the business owner to have to have those additional requirements before laying out the operational framework of their business. And so the length of time that you have been operating a business should be one consideration. In addition, the length of time that you expect to operate this business should also be another consideration. Many business owners draft 5-year plans in their business with their business plans that come with projections and otherwise. And some business owners are not able to fathom whether or not this idea will still be marketable in 5 years or whether or not it will even make it for 5 years. And so, in that regard, I would tell business owners to hold off, think a little bit more about the longevity plan or the exit plan for the business or the merger plan. But what is the end goal of that business? And if the end goal of that business is, to own the business in perpetuity, to develop a very clear plan to ensure that every year you are doing the business. Many businesses, I think it's a known statistic that about 43 to 50% of businesses fail in the first 5 years. And so, not saying wait 5 years to incorporate your entity, but at least take some time to sit down with the business, understand the business model, understand what comes with running your business, operating the business, growing the business before determining that you want to go full on into having limited liability over that business. Another consideration prior to formation is the amount of capital that you need to operate your business. And so this is true not only for the LLC, but for the C Corp as well, because you may find that you need way more money than you expected to operate your business. You may find that you need to solicit outside investors or get a loan. And you want to ensure that your business is formed in the best possible way to reach your financial goals. And so, if you're thinking about getting a loan, it might be beneficial for you to start as an LLC and to move all of your personal assets into your business and then provide a valuation for your business, such that maybe you have 2 homes and now one of your homes is owned by the business. This now provides your business with a basis, assuming that the home is owned outright, of upward of $200,000, etc., depending on the value of the home. So certainly, a bank or another funding entity would feel more than comfortable with providing you with a $10,000 to $20,000 loan for your business if you are proving that you have X amount of assets in your business. Or similarly, you don't have that many assets and you want to do a capital raise and you want to sell shares in the business. You can't sell shares of an LLC, so you would need to incorporate as a C corporation. And so if you are thinking about the amount of capital that you need or how you intend to receive that capital, it may be beneficial for you to consider the amount of capital you need prior to formation to determine what your specific entity structure should be. Additionally, thinking about your personnel. Who will be the owners of this business? Will you be operating the business by yourself? Will you be operating the business with people who are investing in the business? Are you operating with people who own the business because they do a particular function of the business? Are you hiring contractors and limiting the ownership structure to yourself only or the people, the close-knit circle that you have already? Who are you paying? Who's paying you? And are those people that you're paying contractors or are they employees? If they're employees, at a certain point, it may be most beneficial for you to sever that tax liability, similar to what I talked about with the S corporation, because your self-employment tax will be able to be cut in half, and all of your employees would be subject to payroll tax, self Medicare tax, Social Security tax, and that would limit the S corporation's taxable liability. However, if it's a contractor, you may find that because the contractors are paying their own taxes, that it's beneficial for you to stay as an LLC so that you can write off some of those expenses. Similarly, if you have investors, are you issuing them shares such that you should incorporate as a C corporation? Are you uh, going to be giving them their money back such that this is just a loan agreement and is it in exchange for equity in the company, or is it in exchange for a percentage of interest received again at the back end? And so these different formation considerations are generally what most business owners use and think about before incorporating their entity, which kind of allows them to have a better and separation plan for considering where they're going and how they're going to get there. And so, as I love beating into the ground during every slide, you may find a very large benefit with separating your business assets from your personal assets, and your business contracts from your personal contracts, and your personal bank account that your spouse and your kids use to go on vacation from that business account, just to make sure the business is running. And so if you're finding that need for a separation of assets, it would be a beneficial for you to incorporate. Now, some ideas of when you should incorporate generally are when you have a strong idea that this is a viable business with longevity. Additionally, I don't expect that everybody thought I'd talk so much about taxes in business formation. However, sometimes there are additional tax benefits to operating a certain company structure. As you all may know, grants that public companies give out oftentimes are only eligible to be received by nonprofit entities. And so in that scenario, you might find it beneficial for your purpose of operating your business to have a nonprofit entity, and then use that nonprofit entity to further your specific charitable purpose, get a grant, and then maybe create a public benefit corporation, which would be taxed as a for-profit entity, to share some of those funds, or merge some of those companies after you've received some of that funding, depending on what those funding guidelines are. And additionally, that financial and administrative documentation, um, when do you need that? Are you going for a specific grant or loan that requires you to be an LLC, that requires you to have 51% ownership, uh, that requires you to have a certain demographic of your owners, etc. And so these are very specific considerations that people make for when they should incorporate, why they should incorporate, and how they should incorporate. And it's very it's common for, I was going to say very uncommon. But it's very common for business owners to have more than one business structure. So they may have a nonprofit that they operate with their board on one idea that serves a charitable purpose, and then maybe another business that they own entirely by themselves, or a closely held business that they have with their family that does an entirely separate service, but then provides and gets some benefit directly from the nonprofit through services, contracts, and some of that administrative and financial documentation that we've been talking about. I'm happy to discuss any questions at this time. I know we have a couple in the chat, and so I'm sure Delilah will help me through there as well. So if you all have any follow-up questions throughout my Q&A, please feel free to drop it in the chat. And I hope this was helpful to you so far. So please.
Awesome. Joshua, thank you so much. If you want to turn off your screen share.
One right before I do,
Yeah.
I would
yeah,
just invite everyone contact me or contact Legal Core essentially for any further information. You can scan this QR code to the extent that you have two devices and you're able to do this or something. But otherwise, you can send me an email. You can take my contact information, and Legal Core is always available and here to help you. So I will also drop my contact information in the chat box so that you will have it. And I hope to speak with you all again soon. Thank you so much for coming and for ILT today.